Hi, this is Bitcoin Asset Research with Allard. Today I want to talk about Bitcoin asset investing, the what, why, how it works. And I think we can begin with something we can all agree on, that more Bitcoin is good. So ultimately the purpose here is to passively increase how much Bitcoin you own in total. So by Bitcoin you own in total, I do mean, of course, your cold storage stack. Any hot wallet Bitcoin, could be Muun wallet, Phoenix wallet, anything that you might have on exchanges, and anything that you hold via proxy. So this could be the spot ETFs if you're into that, an LLC or corporation you control that has a Bitcoin reserve strategy, or equity ownership in a publicly traded company that holds Bitcoin. So obviously you should only put into fiat what you're willing to lose. And when I say this, fiat is of course referring to the local printed ice cube that go by many different names. This is the US dollar ice cube, and we call them ice cubes because you can see a picture of this ice cube melting over the last few decades. But in this context, fiat really means anything where you don't hold the keys to. Because of course, if you don't hold the keys, then you're subject to someone else's decree. Fiat means decree. So the risk-free asset is really to hold your sats in cold storage. You want to passively increase your sats over time? Well, then you have to take on some risk. And it's important to note that taking on risk, this isn't a fiat invention, right? This isn't something that was created during the fiat standard. This is a universal rule of finance. If you want to compound your capital, if you want to grow it, you have to put that capital at risk. And that risk on the Bitcoin standard means that your Bitcoin are held with someone else temporarily. And this could be on a lending platform like BlockFi or Celsius, where you deposited Bitcoin into one of these platforms. But we obviously know how this risk panned out for the users. But it could also mean having your Bitcoin be held at a company like MicroStrategy, which has successfully increased BTC per share for the last 4 years. This is a chart showing MSTR shareholders BTC per share increasing ever since MicroStrategy adopted its Bitcoin strategy. Which means that if you bought a share of MSTR 3 years ago and held onto it and did absolutely nothing else, then you would own more sats than you did back then, just purely passively, right? So 3 years ago, you bought a share, that share represented some amount of Bitcoin, and now that same share actually represents more Bitcoin because Bitcoin per share has grown up. Note that passively is the key here. That's what investing is. It's the passive compounding of capital. I didn't do any work. I didn't do any additional work except to hit the buy button on this asset and commit my capital to it. And then my capital is growing over time. So another example of this would just be buying any stock. You buy Apple stock and you actually get 3 sources of passive capital compounding. These are buybacks. Apple buys back a huge volume of its stocks. It can also be dividends. Apple obviously pays a dividend. It's not a huge yield or anything, but it is something. And it's the appreciation of equity book value, which obviously gets reflected onto the market price via the price to book value ratio. So if you like this video so far, I just ask you to do these simple things to really help expand my reach. I would really appreciate it. On a Bitcoin standard, this dynamic doesn't really change, this dynamic of risk taking in order to compound capital. You're still after these same things, buybacks, dividends, and book value growth. But since at this moment in time, Bitcoin is the asset to purchase, you can just look to increase your Bitcoin per share. Now, BTC Yield is this KPI which MicroStrategy pioneered. We can see here MicroStrategy acquires 7,420 Bitcoin and achieves a BTC yield of 17.8% year to date. What they mean by Bitcoin yield, MicroStrategy defines BTC yield as the amount of Bitcoin per share based on assumed diluted shares outstanding, which is just a maximum, most conservative assumption of how many shares there are. They're assuming that all of that convertible debt is converted into real shares. So as this number grows over time, that is reflected by a positive BTC yield. And this is the essence of Bitcoin asset investing. I would say it's just achieving this BTC yield for all the assets that you own. You buy stuff which can feasibly increase Bitcoin per share. This means you're passively increasing your total Bitcoin. Again, passively is the key here. Now, you don't have to do this, of course. You don't have to buy index funds or real estate. You don't have to invest at all. And what's wonderful about the Bitcoin standard is that you can hold sats just in cold storage, and it will still protect you from a purchasing power perspective. But if you will invest, Bitcoin should be your benchmark. I don't think this can be disputed here because when you look at Bitcoin priced in the S&P 500, this is S&P Total Return Index, over the last 10 years, it has absolutely collapsed in value when measured in Bitcoin. If you look at the all-time, it's done even worse. It started off here with 585 Bitcoin was worth one S&P 500 total return index. And now we're sitting at less than 0.2 Bitcoin. So that's clearly collapsed in value. And along all time frames that are relevant, this same collapse in value can be observed. And you can go on this website and really play around with it. So this is the NASDAQ as a reference point measured in Bitcoin. This is gold measured in Bitcoin. This is US income. So really everything is collapsing in price when compared to Bitcoin. So Bitcoin should be your benchmark. And the only way you can sensibly beat this benchmark is if you're buying things that increase your Bitcoin over time. So does this mean mining stocks? No, not really. In fact, I'd argue not at all. Because if you look at the performance of Bitcoin against a list of some of the biggest miners, you get this clear outperformance of Bitcoin. So Mara is the exception here. But as you go down this list in the 5-year chart, none of these miners are reaching Bitcoin's returns, right? So Bitcoin got 659%. And none of these miners are beating it. And again, Mara is just the one exception over here. And on the 3-year timeline, that becomes even more apparent. And especially on the 1-year timeline, it becomes very apparent. So that's just a quick reference point that miners don't actually outperform Bitcoin. So it doesn't really make sense to buy a Bitcoin mining operation when you just look at this analysis at face value. And here I wrote an article a few months back where I took a look at the Bitcoin miners ETF, WGMI, WAGMI. And the summary here, Bitcoin mining is a highly competitive industry. It's actually what I would consider the only perfectly competitive industry in the world. The barriers to entries are so low. There's no ability for the producers, the miners, to determine prices. And that makes it very difficult for publicly traded miners to outperform Bitcoin. And there's really this question that you have to answer here that I wrote later on. If gold and silver miners underperform the commodity, so gold miners underperform gold and silver miners tend to underperform silver. You can see here, this is a chart of GLD, the gold ETF, completely dominating GDX, which is the gold miners ETF. So if this is the case with gold and silver mining, why would it be not the case for Bitcoin mining? And Bitcoin mining is far more competitive and far more of a zero-sum game than gold and silver mining, because of course Bitcoin has absolute scarcity. So anyone can really buy Bitcoin. You don't really need to mine Bitcoin for it to work. And non-miners are actually more efficient at acquiring Bitcoin than miners. And that's what's so exciting about Bitcoin asset investing. It's not just about Bitcoin mining and hash rate and energy. Eventually it will encompass more companies. Here's bitcointreasuries.net. There's many different companies that have Bitcoin strategies. Not all of these are miners. In fact, the biggest one, MicroStrategy, is obviously not a miner. And then when you go a few steps down, you have Tesla, which is also not a Bitcoin miner. And this list will grow to include the entire stock market. I think this is very much inevitable if Bitcoin keeps going the way it's going. Eventually, it will encompass digital assets as well. Here's a 2018 article about the Bitcoin risk spectrum by Nick Bhatia. And you can see that his perspective, Bitcoin staked to Lightning, is the most unique income-producing asset in all of monetary history. This is really just the point about routing liquidity over the Lightning Network. And a product that allows you to do that, although not exactly routing. This is Amboss, which runs a Lightning marketplace where you can buy and sell Lightning channels. And there's quite a bit of Bitcoin being deployed here, and this is their average APR that you're able to earn when you use this program. Now, this is definitely not passive, but you can imagine an operation where someone could do this automated for you, and then you would pay them a small fee for doing that, and then they would give you the rest of the APR earned. In fact, Amboss does have an automation option, although this is just more channel management and not really for prioritizing yields. There's also Join Market via the Jam app. Join Market is obviously a way to collaborate on coin joins. And here it says fees on Join Market are earned by market makers. And those are people who provide liquidity to the open market for these coin joins. Here we see a Join Market order book. And you can clearly see that these are the fees that are being listed. So if some person wanted to do a coin join, they could pay these liquidity providers. They could pay them this fee in order to execute the coin join and gain some privacy. So this is kind of like a marketplace for privacy on demand. And of course, you have stuff like Botanic's protocol, which is an EVM equivalent layer on Bitcoin. Botanix uses proof of stake as the consensus mechanism, and BTC serves as the proof of stake token that is used to secure this ecosystem. I'm actually quite bullish about Botanix, because if you're able to make proof of stake work with the Bitcoin token, then what is the need for all these 50 other proof of stake altcoins? It just seems that Bitcoin will end up swallowing the market for crypto via something like proof of stake on Bitcoin via Botanix. And this is not surprising, because Bitcoin will eat the world by repricing it. It's already starting to happen. This is what we mean when we say that fill in the blank has been crashing for over 10 years when measured in Bitcoin terms. As you've just seen in those charts I showed, everything is crashing in Bitcoin terms. A new benchmark is here. Alpha must be generated, and alpha is the financial term for the outperformance of an investment strategy over some investment benchmark. And alpha must be generated in Bitcoin terms. And Bitcoin is ultra low time preference unit of account. So it's the only fit way to measure value. And it's the only fit benchmark for evaluating your investment returns. So that concludes the video. Thank you for watching. Leave your questions and comments in the comments below, and I'll see you in the next video. Bye.